Thank you very much, everybody, for joining us this afternoon. The intention is that we'll go through a presentation that will take somewhere between 30 and 35 minutes. It's broken up into a series of fairly standalone sections, so we'll pace that so that everybody's got time to sort of really understand what we're discussing. Andy and I will split the presentation between us, and then when we get to the end, we will open up for hopefully around 20 to 25 minutes of Q&A. So I'll just take us through the initial section. We'll just provide a very short introduction to the group to help you navigate the presentation. But fundamentally, what is our purpose and what do we do? So Tracsis as a business largely develops innovative technology. We solve complex problems and we maximize efficiency in critical and regulated industries. What do we mean by that? Well, half our business is in the rail technology space. And in that space, we have a large number of both software and hardware products. And then we also operate in the data analytics, the data capture, and in the event traffic management space, which is more of a services-based part to our business. But again, it's all focused around solving complexity around transportation or about large event management. And everything we do has quite a significant positive impact on E and S outcomes for our customers. So in this presentation, we've got a dedicated ESG section, and what you'll see in there is how we both are taking ESG seriously ourselves, but also how our products and services help our customers to also meet their objectives. In terms of helping you to navigate this presentation, we use a color coding so that you can understand how the different parts of the business fit together. So anything that is in green relates to our products business, which is all in the rail technology and services space. And anything you see in dark blue is in data analytics, consultancy, and events. And you'll see that theme carried throughout the presentation. We currently have around 500 employees based in the UK or in Ireland. And what you'll see as we go through the presentation, we'll talk about the different elements of the business. We'll bring it to life. We'll talk you through what's been achieved in the past 6 months so that you get a real sense of what we've been delivering as a business. So I'll just kick off with the overview of the year. So we're very pleased with the outcome. The team has done an outstanding job delivering the results against what's actually been a more complicated COVID background than we had in the previous financial year. So last year, we estimated the COVID headwinds as being around 10 million of lost revenue. And this year, it's been slightly higher at 12 million of lost revenue. But despite that, we delivered revenue growth and quite significant organic revenue growth in our rail technology business. And more importantly, we've delivered very strong EBITDA growth. And that's been driven by both the mix of our revenue, so it's more heavily based towards rail technology, but also reflects the fact that over 18 months ago, we took quite a number of decisive cost reduction measures just to ensure that the business was on a robust footing as we went through the pandemic. Cash is strong. We've won a number of important contract wins in the period, which underpin our confidence. We currently have a record pipeline of opportunities, and we're also well placed to benefit from the recommendations of the Williams-Shapps rail review. We'll go into detail on all of these points as we go through the presentation. But firstly, I'll hand over to Andy, who'll walk you through a more detailed overview of the financials.
Thanks, Chris. So in terms of the financial highlights, as Chris mentioned, we've delivered a growth in revenue and in profit despite some of the challenges that the pandemic continued to throw at us. So revenue in total was up 4.7% for the group. And if we take out the parts of the group that were directly impacted by COVID, which is the traffic data, the events, and the transactional delay repay businesses, and if we adjust for the annualized effect and benefit from businesses we acquired in the prior year and in the current financial year, the rest of the group delivered organic growth of 8% in total. And that was particularly strong on the rail technology and services side of the business, where the organic growth was 10.9%. Adjusted EBITDA grew by 24% to £13 million. As Chris mentioned, we've got a very strong balance sheet position, and we closed the year with £25.4 million of cash and no debt. We're showing for the first time an annually recurring and repeating revenue metric. I'll talk you through the details of this in a subsequent slide, but for the group as a whole, that's roughly 56% of our revenue, and in the rail technology side, that climbs to 70%. And M&A remains an important part of our growth strategy. And this calendar year, we've completed 2 acquisitions. The first was Flash Forward, which was acquired in February and has been integrated into our transport consultancy offering in the second half of the financial year. And then last week, we acquired the Icon Group, which fits in the data analytics GIS space. And we'll talk a little bit more about that in due course in this presentation. So this slide, there's quite a lot of information on this slide. The boxes on the left-hand side show the share of group revenue for each of our product categories. And what you can see towards the top left is the growth that we've seen on the rail technology side of the business. So the rail software includes some important contract wins during the year, and the remote condition monitoring side of the business also delivered record performance this year. In the bottom left-hand corner, you can see the traffic data and events businesses that were most directly impacted by the pandemic. And there we have seen revenues decrease year on year. And in the rest of the group, on the top right, the data informatics side has grown. And this is part of the business that we're continuing to invest in. And in the transport consultancy piece, now that we've integrated Flash Forward, we've now got a much broader consultancy offering that spans right across the Tracsis group and into a much broader customer base in the transport industry. And the charts on the right-hand side try to show what the recurring and repeat revenue percentage is for each of the two divisions. So what we've included in here is recurring revenue from annual software license and maintenance agreements. We've included annually repeating hardware revenue from framework agreements, and we've included annually repeating large contract revenue. And on the rail technology side of the business, we estimate that is roughly 70% of that division's revenue. Most of the remaining 30% represents development work that is done for our customers under license, which then helps to drive the pipeline of future recurring software license revenue further down the track. Just looking at the income statement in a bit more detail, we'll talk through the drivers of revenue growth on the next slide. The adjusted EBITDA number of £13 million includes £1.8 million benefit from the actions we took to take cost out of the business in response to the pandemic. Much of that is variable costs that will return as activity levels improve and increase, but some of that we're looking to retain as embedded cost savings in the business that will drive margin improvements moving forward. We continue to use the furlough scheme this year, and that benefited the P&L to the tune of £900,000. That scheme has worked really well for us. We think it enabled us to retain roughly 150 jobs across the group and meant that we were really well positioned to respond quickly when we saw activity levels picking up in the events and the traffic data businesses as the COVID restrictions were eased. The chart on this slide bridges the revenue growth from FY20 to FY21. So you can see in that first red bar the additional headwind we had this year from the three parts of the group that were directly impacted by the pandemic. And as Chris said, if we were bridging this back to FY19 revenue, that would be the total £12 million headwind that we've experienced. Within this financial year, that was more or less offset by the annualised benefit from acquisitions. And then we delivered £2.4 million of revenue growth from organic growth, which was mostly on the rail technology and services side of the business. Just looking at the divisional performance in a bit more detail. So on the left with the rail technology and services division, strong revenue growth as we've seen. That includes the organic growth, the record level of remote condition monitoring revenue, and the benefit from prior period acquisitions. And on this side of the business, we've got a record pipeline and we're seeing very high activity levels. For the data analytics consultancy and events division, revenue decreased by 3%, which was driven by COVID. But the businesses there did a really good job of mitigating that where possible, including, for example, in the events business, where they delivered £1.3 million of revenue supporting COVID test and vaccination centres. We have seen continued growth in the data analytics GIS business. And on this side of the business, this is where we see most of the benefit from the cost savings and from the furlough scheme. And therefore, the EBITDA margin of 16% is somewhat higher than we'd normally expect to see on this side of the business, which would be more towards the sort of lower double-digit margins. Turning to cash flow, so the group is very cash generative. We had £25.4 million of cash on the balance sheet at the end of the year. We've got no debt and no deferrals, so that's all very clean. There was a slight phasing impact on working capital because we had a very strong July, particularly in the events business, as the COVID restrictions were eased. But all of those receivables have been recovered in the first quarter of this year. And that £25.4 million gives us the firepower to continue to invest in growing the business, both in driving organic growth and in non-organic acquisitive growth. So £1.9 million of cash was used up front as part of the Icon acquisition last week. And we estimate there's approximately another £5 million that's due out in this financial year, this coming financial year, in respect of contingent and deferred consideration, which we're very happy to pay because it demonstrates that those businesses are performing well. And then lastly, we have continued to make operational improvements across the business as we integrate the group model and as we set the foundations to ensure that we can deliver scalable growth as we convert the pipeline of opportunities ahead of us. So that includes fully rolling out the new group-wide branding. We have implemented a shared service model right across the group in all of the key support functions, including finance, HR, quality, health and safety, IT security. The Innovation Hub has been fully launched to enhance collaboration across our businesses to drive the next generation of products. We've achieved ISO 27001 accreditation across all of our software and IT-driven business units, which is a really important milestone for us in terms of making sure that there are no barriers from a procurement perspective for us to continue to grow the group. We'll talk about ESG in a little bit more detail further on in the presentation. And the other area where we're very focused is in continuing to invest in our people. So we hired a group people director in the summer, and this is all about making sure that we've got development plans in place to grow our people, to retain our people, and to make sure that Tracsis is a really attractive place for people to come to work. So with that, I'll hand back to Chris to talk through the growth strategy.
Okay, thanks, Andy. So in terms of our growth strategy, as we've talked a number of times before, the growth moving forward at the moment is focused in 5 areas. So we talked about traffic data and events. Those businesses are very much focused on the COVID recovery at the moment and on recovering additional margin growth as they come back to full capacity. In the other areas of the group, we're focusing on investment in new products and investment in accelerating the capability that we have. So following the color coding that we talked about earlier on, you can see there's 4 areas of the business within the rail technology space where we're focusing our growth strategy, and 1 area on the data analytics and GIS side. So the next slide we're going to share will talk specifically about the Williams-Shapps review in the context of the 4 rail growth drivers. And then we'll go through a single page on each of these growth areas to explain where we are in our growth journey and what has been delivered over the course of the past 12 months. So if we first of all talk about the Williams-Shapps review, so this was announced by the government in May of this year. It has been a review that has been ongoing for, I think it was 2 years in total. And it was designed to look at the structure of the UK rail industry and make recommendations on how it needed to evolve and change to deliver ultimately improvements for the customer experience. So here we've captured what we think are the key headlines from our perspective, but it's part of a much broader review, which is accessible online to anybody that wants to read this, the review in more detail. So the fundamental change is the creation of a new supervisory body called Great British Railways. Now that is being implemented as we speak. We expect that to take somewhere in the region of 2 years to be fully implemented. But the concept behind it is to move towards a more centralized model in the UK, where we break down some of the barriers between the infrastructure provision and the train operators, so that we end up in a situation where there's much freer sharing of data, much more integration around capacity, timetabling, how you recover services when there might be any issues, ultimately through to making sure that the customer ends up with an on-time and high-quality rail service. So we've got a foothold in many different parts of the rail industry, and we think this move will actually help bring a number of those different opportunities together as different stakeholders start to share more data and start to share more information. Alongside that, the passenger services provided by the train operators are going to change. So it looks like everybody is going to move to a concession type model. And what that means is that each company that will run a rail franchise will be given a management fee to run that franchise, but then there will be penalties linked to poor performance. So there's going to become an increasing requirement for high levels of efficiency, high levels of on-time service delivery, and also requirement that all elements of service quality, so whether that be stations, rolling stock, customer information, ticketing, any element related to your touch points with the railway will be under very heavy scrutiny in terms of making sure that they are improving over time. So we'll still continue to see a large number of differentiated rail or train operators, but they will increasingly follow a very similar model that will be dictated by Great British Railways. So within that, we will also likely see a nationwide expansion of pay-as-you-go smart ticketing. For those of you know us well, we bought a business called iBlocks in March 2020, which are currently the only UK supplier of an accredited rail-based pay-as-you-go smart ticketing system. And we'll talk a little bit more about that in a moment. But we think that business is very well placed to help with the much broader rollout of this type of technology. So in summary, the easiest way to understand it is really it would be like an equivalent of Oyster Card, but for mainline rail across the UK, especially focused around commuter routes rather than long haul routes. And then the final significant change that we're likely to see a benefit from is that the network is being opened much more to freight. We don't believe as an industry that we're going to ever go back to 100% of the passenger numbers that we saw before the pandemic. So freight is being given a greater share of the market. Freight operations tend to be much simpler because they've always had a much more restricted access, but increasingly the level of complexity involved in those operations is increasing, and there's an increasing requirement for tools and processes to support what they do. So we believe in each of these areas, there's a very strong alignment between the products and services we offer, the capability and the skill sets that we have within our business, and the industry's demand for what we do. So we are making sure that we're as well placed as we can be in each of these areas to help the industry achieve its ultimate objectives moving forward. So in that context, now looking at each of the individual areas, so the first growth area is an operational performance software. Our key product in this area is a product called Tracsis Enterprise, which anybody familiar with us will have heard us discuss on a number of occasions before. We have several contracts being developed under license, and the first two of those with passenger operators have now confirmed go live dates in January, February, and March of next year. So that's a really important milestone for us in terms of being able to demonstrate in the live environment the benefits case that this software can offer, and will become a great springboard for hopefully a lot more opportunity in this space. So as we sit today, we've got a record pipeline of opportunities here, both with other train operators and with freight operators. And we're hoping, given the procurement stages of those opportunities, to see a really strong revenue growth in this area moving forward. In the second area, which is remote condition monitoring, we've seen a record year this year. IoT on the railway is a theme now that is growing in importance and in growing in its frequency by which it's being discussed. We have a significant installed base in the UK, which has been put in place over the last 10 to 15 years. That includes both hardware in the form of data loggers, but also a data acquisition platform called Centrix, which allows you to interpret, set alarms, set trends, and understand where your biggest risks are in terms of your infrastructure provision. Alongside that, we launched a new product this year called BuzzBar, which looks at power supply monitoring. And you would have seen us announce a US contract win with a large US transit agency. We can't disclose publicly who that is yet, but it's an opportunity whereby when that becomes public knowledge, will become a really interesting reference point for hopefully future and consistent growth in North America. And that opportunity included both the installation of Centrix within the firewall of the client, and also the installation of a significant number of data loggers. Those installations are expected to complete early in the new year. In the third area, our growth is driven by a product called RailHub. So RailHub is a product that's developed by OnTrack, which is one of the businesses we acquired 4 or 5 years ago into the group. So RailHub has always had a historic customer base within the supply chain within the UK, and there were over 15,000 users across many of the contractors that supply services into the UK rail sector. We've won a significant multi-year contract this year to expand that user base to 30,000 users. This will become more public knowledge in the new year when the client goes public with its initiative here, which is all around basically saving lives on the railway. So the ultimate objective is 0 fatalities in anybody connected with providing maintenance or infrastructure upgrade work within the UK rail network. And how the product works is it's all tablet or mobile based. When you sign in, it looks at your competency matrix and confirms that you have the skills and the necessary training to access the site. and it provides everything that you need, including your digital workflow, schematics, asset data, all of the various permissions that you need to access the railway in a safe manner are all contained within that digital workflow. So it's a really interesting product that demonstrates the power of digital and how that can be used to enhance safety and working practices within the rail environment. And the final area on the rail side is smart ticketing. So we have, as I said earlier in this presentation, a proven pay-as-you-go platform. It's already deployed on around 20% of the UK's rail network. So Southern, Thameslink, Great Northern and South Western trains all use our technology, and it's the fastest growing revenue type in the UK right now. So post-COVID, it has accelerated the rate at which rail passengers have returned. So it's clear signs that people like this technology and are using this technology. The way it works is that we are agnostic as to how the user interfaces with the system. So they could have it via a smart card, you could do it via your credit or your debit card, or you could use a mobile app or a barcode. As long as we can see that you've passed through a station, both on entry and exit, it doesn't matter how we obtain that data. So there are a number of different methods in which our technology can be deployed. And on Monday of this week, we secured another contract, which will become public domain referenced within the next 1 or 2 weeks, which again gives us increasing confidence that we are starting to see a much wider interest and much wider deployment of this type of technology. What we've done to try and capture all of that together is to try and outline what we think the addressable market is for those technologies. So the green bars are the revenue that we delivered as a company this year in rail technology. So that's just over £26 million. And you can see that we think the market in the areas in which we operate is about 100 million in total in the UK. So within those grey bars are two elements. There's a competitor element. So in our markets, we do have competitors, and those competitors have a market share. And obviously what we're looking to do is to gain access to that market share and to turn that into Tracsis revenue. But what we're also seeing is a white space in a number of these markets where there either aren't digital processes or software currently being used by our clients, but that we can see that there's a strong demand for big data or for more process optimization or for whatever else might be driving the need to implement more sophisticated software or hardware solutions within the client base. So you can see there's a lot of opportunity here. Quite clearly, if we could access other markets, so we have a very small amount of revenue comes from North America, for example, for rail, then quite clearly that would also help to drive a much bigger market share for the organization moving forward. Just a couple of final slides in this section. So just to balance up where we're focusing our growth in data analytics and GIS. So we've seen a lot of growth this year. This is an Irish-based business. We've seen a lot of growth this year in terms of UK revenue for Compass Informatics, which was part of our strategic objective when we acquired them. We're seeing an increasing interest in regulated industries, so primarily transportation, but also environmental and utilities, for people understanding where their assets are and how those assets are performing against the targets that those organizations are being set, either from pure government regulation or just in terms of operational performance challenges. So in that light, we have recently, only last week, acquired Icon Group. And Icon Group bring a specific skill set that we don't have within data analytics and GIS. So they specialize in what's called Earth observation, which is in the analysis of satellite imagery. And we think there's a really big opportunity, not only just to continue to grow the business as it stands today, but also to look at opportunities as to how we can take their capabilities and use them within the rail space. So we have access to obviously a huge amount of data within the rail technology market. Can we integrate that better into both the skill sets that Icon have, but also our existing business Compass Informatics has, to increase our ability to exploit that data and to make sure we're offering real customer insights to our client. So this is a really exciting addition to the group, and across all of the different areas we've got a very strong pipeline, and we think we're in a very strong position to continue to grow those businesses moving forward. So I'll now hand you over to Andy, who will just walk you through where we've got to with our ESG policy and an approach.
Thanks, Chris. Yeah, I just wanted to give a quick overview of how Tracsis is thinking about ESG. in terms of how it impacts our business model and also how we are maturing our policy and ultimately our targets in this area. So the first slide sort of sets out the status quo, if you like, in the situation at the moment. And we feel that we're building from a strong foundation here. So in terms of Tracsis itself, by the nature of what we do, we don't have a very big carbon footprint. We're a pretty environmentally friendly business. I think we have a track record, particularly at a business unit level and at local site level, of positive social impact on our communities. And we've got a well-established corporate governance framework. And what we're really particularly proud of on the right-hand side, and this is by no means an exhaustive list, but is how the products and the services that we offer really help our customers to also deliver positive E&S outcomes in the spaces that they play. So for example, the RailHub product that Chris talked about earlier is all about reducing accidents and ultimately reducing fatalities on the railway. And much of the rest of the rail tech business is about encouraging people out of cars onto a much lower carbon form of transport. Compass Informatics does a lot of work with various customers about more efficient use of environmental and natural resources. And the traffic data and the events businesses also help to make sure that traffic flows are optimized, whether that's in a static situation or when putting on major events. So that's really important to us as a business and for our customers. In terms of how we're thinking about this, we're really keen to make sure that ESG for us is something that's really meaningful and impactful for our people. So we set up a working group with representation from right across the Tracsis group and at all levels of the organization. And we asked them to start thinking about what's really important to our people. What would they like to see us doing in the ESG space that would make Tracsis a really standout organization for them? And we've rolled out the first set of policies this year in response to that. And the three areas that are highlighted on the left were the ones that came out as the first areas that our people wanted us to focus on. So a very big focus on volunteering and community outreach, making sure that we were using green and renewable energy supply, and making sure that our waste management was appropriate, that we were recycling and reusing as much as possible. And as we mentioned earlier, we've also recruited a director of people this year to make sure that our people processes are where they should be. And that includes leading an initiative to enhance diversity and ensure we have learning and development frameworks in place. So as we move forward with this, what we're looking to do is to improve our reporting and transparency on the ESG side of things. So this time next year, we will have a scorecard in place with a set of KPIs that make sure that everybody can see what we're doing as a business, how we're performing, what our targets are, and whether we're delivering those. And that's particularly important in the climate-related reporting. And the other area that's come out of the working group is a focus on equality, diversity, and inclusion. So that's another focus area for us going forward. We think we're okay at the moment, but like every business, there's room for improvement. And that will be a key focus area for us in FY22. So I'll hand you back to Chris to cover the forward-looking view for the group.
Great, thank you, Andy. So just a last couple of final slides here, really just to summarise what we've spoken about over the last half an hour. So on the rail technology side, we think we're really well positioned to continue to grow. There will undoubtedly be some challenges as the UK industry transitions to its new operational structure, but we think we are offering products that make a real difference and offer a benefits case that is going to be a key part of enabling the industry to offer that enhanced experience to consumers, and whether that be through passenger rail operation, freight operation, or through the delivery of more high-performing infrastructure, we think we're in a really strong place to help. The fact that we've got multiple growth vectors in different parts of the industry is also important, and obviously, clearly, we'll continue to invest in this area and make sure that we are sitting at the forefront of technology in each of these sectors. International growth also remains something of interest. And we're always looking for opportunities to expand our footprint should the right ones come along. On the data analytics consultancy and events side of the business, we've spoken about the recent acquisition within data analytics and GIS and what our plans are there. But in addition to that, it's about continuing to grow our transport consultancy business, which is making really good progress and has got an important role to play again in the industry transition stages over the coming months. But it's also importantly about both the events and traffic data businesses returning to normal monthly revenue levels. So as we said on the events side, the events business is getting very close now to being back to sort of what we call normal monthly revenue levels. The team is very busy in planning a number of activities over the Christmas period, and all of the major events that we'd expect to run through 2022 are all now in the final stages of or detailed stages of planning, which is great. On the traffic data side, that business is a little bit more of a lagging indicator, and we're currently somewhere in the region of 70 to 80% of normal expectations around pipeline. So that business is taking a little bit longer to return to normal, but we've got some large contracts underpinning that business, and we expect that to return to normal run rates through the second half of this year. So the team have done a fantastic job on this side of the business, being very resilient to the COVID crisis. And the thing I'm particularly proud of as a business is that as well as taking the furlough, using the furlough scheme, myself, Max when he was CFO, and others all the way through the business took a 10% pay cut early in the crisis to make sure we were in a strong position to see out the pandemic. And I'm really proud to say that we were able to pay everybody back who took that pay reduction in July of this year. So that's included within our financial results. So what that has meant is not only have we managed to keep all of the capability that we wanted to keep within the business, it's also meant we've been able to accelerate our recovery as opportunities have started to open up since restrictions were lifted in the summer. So I'm really proud of the fact that we've got a very motivated, very engaged team who've done a really outstanding job through what has been a very challenging last 15 to 18 months. So in conclusion, we've had a strong Q1. I'm spending increasing amounts of my time on M&A, so we're looking very much to continue to accelerate that as part of our growth plan. We've got a record pipeline of large multi-year contracts in the final stages of contract award, which puts us in a very strong position, and we will obviously provide more information on those as we secure those over the coming months. And therefore, in summary, this is all about successfully delivering the large projects we already have. It's about closing out the pipeline that we've got that's very close to being realized and being delivered. We will continue to focus on M&A growth in the 5 areas that we talked about in this presentation. We will continue to build and develop our ESG strategy, and as Andy said, to develop a scorecard around which we can see real transparency and progress. And so all in all, we've got a very strong, very clear 3-year growth plan for the group, and we're very confident in our ability to continue to grow and expand the organisation. So that concludes the presentation, and we will now pass back to Tamsin to open up for any questions.
Is there a link between the retention of COVID government support payments and the lack of a dividend payment to shareholders?
Yes, there is. We, as we said, we've used the furlough scheme both in FY20 and in FY21, and it's been really successful for us. And we're really pleased and proud to have retained so many jobs in the business as a result. The board didn't feel it was appropriate while we had taken that money to pay a dividend. By the 31st of July 2021, we weren't using that scheme anymore, and therefore we would hope that we can return the dividend for the coming financial year.
Thank you. And staying on dividends, what should the Tracsis dividend policy be? A 1.5% dividend yield would cost about 4 million and would recover about 2 times by earnings. Is that a reasonable target?
I think our stated policy is to deliver a progressive dividend, and clearly it's very early to say at this stage, but I would anticipate that you can expect us to return to similar progression of the dividend that you saw before COVID had hit the business.
Thank you. And what are the prospects overseas for the rail division, particularly the rail condition monitoring product?
Okay, so that of all of our products is the most easily exportable. For any overseas market, it typically just needs a modification to its power supply. So we've got installs in Australia and we've got installs in North America. In the North American market, we continue to use a reseller who represents us across a wide customer base. And we've obviously won historically both contracts in the Class 1 freight sector and also now in the passenger transport space in North America. Australia, we don't have any representation, but we have bid in the past a number of contracts as they've become available. Moving forward, Andy and I would both like to find a method by which we can more substantially establish ourselves, especially in North America. We think there is a really nice market there for a number of our products and services, but what we need is to find the sales channels to enable us to support that growth. So that's something we've been looking at in detail. We've done a large market study looking at the North American market, and we're still working through that to try and understand what is the best means of attack for us in that marketplace. But we would absolutely love to take this business with a much wider international footing over the coming months and years.
Thank you very much. Your P&L didn't include after-tax profit and earnings per share. How do they compare with previous years?
Yeah, so what you'll see in our tax charge in the P&L this year is the effect of UK announced an increase in corporation tax rates from 19% progressively upwards to mid-20s, and the revaluation of our deferred tax means that we've had that impact coming through the P&L in this year's numbers. So the statutory EPS and the profit after tax reflect that, but the adjusted EPS numbers continue to grow, which is really pleasing.
Thank you. And can you comment on the current state of play regarding unfilled vacancies across the group and your expectations of wage inflation?
Yeah, that's a great question. We've not seen any significant wage inflation yet, but obviously we're very clearly aware that the software market in particular, there are a number of vacancies across the industry, and hence there are opportunities for people to more readily move to new employers, especially with an increasing number of people working from home. We're focused very much by trying to make sure we stay at the leading edge of what we do, keep people very much motivated by the fact we're developing leading edge tech, and that people can be very much part of seeing new products make a real difference in the industry in which we operate. So we have a number of vacancies, largely through growth, and we're going to continue to need to invest in new software heads, new project management heads. We're expanding our HR team a little bit. We're seeing strong numbers of inquiries for each of those jobs, and so far haven't struggled to fill any of those positions. The only areas where we find it a little bit challenging and where we have very unique software language requirements, and as a business what we're trying to do is find ways of changing our approach or changing our architecture so that we can get access to wider pools of software engineers. So for example, Haskell is a very, very specialist software code, and Java is a much more freely available software developer language. So we're trying deliberately to move our strategy moving forward into areas where we can more readily find the right type of resources. And that doesn't have to just be in the UK. That's also, we've now got a number of developers working for us in Eastern Europe.
Thank you. And coming back to rail, you're very strong in the UK rail, but there's very little presence in European rail. What are the barriers to this business?
I think similar to what Chris was saying about the US market, I think what we need to find are access to the sales channels in mainland Europe in order to move our products across there. So again, it's part of our strategy. It's one of the things we're thinking about, and we need to find the right route there for us to be able to sell into local markets. So on the data analytics side, we have nice access to European markets. With our Irish business on the rail side, it's a little bit tougher for us at the moment, and we may need to find an alternative way of gaining access to those markets.
Thank you. And can you provide some details on how iBlock's revenues are generated? What do you see as the medium to long-term revenue potential here?
There's sort of three elements to the iBlock's business. So it does quite a lot of work every year doing software development on behalf of the rail industry. There's the delay repay part of the business, which is a transactional model, partly transactional model with some stage gates built in, and then the smart ticketing piece, which is, as Chris said, is growing, and we're really pleased to have won the latest contract last week. So you'll see from the addressable market slide that we presented that we think there's considerable opportunity to grow from our current position there. So we're really excited about the prospects of that side of the business.
And I guess just to add to that, Andy, for the smart ticketing piece, the model is typically a CapEx investment upfront from our customers, followed by an OpEx model that is typically a transactional based one. So we either get paid per transaction or per hundreds of thousands of transactions with a ratchet mechanism. And so the model's got both growth potential in that the more people that use the technology, the more revenue you create. But it's also got the ability, when customers want a very specific requirement, that solution can be developed effectively on a development under license basis, but through a CapEx model with our clients. So there's 3 different business models within that organization. But yeah, it's a great little business and what our challenge is with that business is really about how do we make sure people get to know more about what it does, because it has some great technology. And it's really about industry awareness. So for anybody that happens to be on LinkedIn and looks at our iBlocks channel, you'll see there's a lot of work at the moment going on to make sure people understand what our smart ticketing technology is, what our delay repay technology is, how much market share we already have, and that we already have a proven solution that could be very much part of the future strategy of Great British Railways. Great,
thank you very much. And would you be prepared to move to a net debt position for the right acquisition?
I think it's very context dependent. I think we are looking to continue to be an acquisitive business, and it may be that if that's going to take us into some new markets, for example, we might have to look at things a little bit more expansive than what we've done in the past. I think the key message is that we wouldn't do anything on the M&A front that jeopardised the core business model, and we wouldn't do anything that kind of bet the farm, if you like. So we would always be doing that in a very cautious and controlled way. But it is possible that we may be looking at deals over the near term and the medium term that are slightly larger than what we've done in the past.
Thank you very much indeed. With the acquisition of Icon Complete, what sort of thing can we expect next? Can you share any insight into expected size, territory, and/or strategic rationale?
Okay, so in terms of our approach, so obviously we've got a very successful history where we've made 16 acquisitions in total now across the group. The slightly different approach we're going to take moving forward is we're going to carry on with that, what we call a bolt-on approach, if that's the right terminology. But the view will be wherever we're buying smaller businesses, they will need to integrate into an existing part of the Tracsis organisation structure. So if you take Icon Group, for example, that is being integrated into an existing business unit, and the managing director responsible for that business unit is responsible for all elements of integration. So that means that Annie and I are keeping our capacity and time available to look for the next opportunity that may come along. So from a repeating what we've done successfully 16 times before, that model will carry on. That's not going to change. But we're certainly putting a lot of time and energy and effort now into slightly bigger opportunities and opportunities in international markets. I can't make any commitment in terms of timing around that because we honestly don't know when that may come about. But as Andy said, if we can find the right deal at the right time, we will go ahead and do that. But we're not going to do anything that jeopardizes the success of the business model we currently have, because there's still a huge headroom here in the UK to continue to grow. But we would love to be able to find opportunities to just continue to push the boundaries of the business, because in particular, we don't want to just be sitting with £25 million on the balance sheet. We want to be utilising that capital to help the business grow.
Thank you, Chris. And that's the end of questions. Do you have any closing remarks?
Just to say thank you very much, everybody, for your interest in the business. The team has done an outstanding job this year. Andy and I couldn't be sat here without the contribution and the success of everybody that works with us. I think we've got huge energy across the business. It's got some brilliant people and some brilliant technology, and we're looking forward to another successful period ahead of us.